Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the best aggressive growth stocks to buy right now. And then at the end of this video, we're going to be going over a few value stocks that offer a very good dividend. So for more videos like this on the best stocks to buy on the stock market, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's story. The first company we're going to talk about is Virgin Galactic Holdings Inc., ticker symbol SPCE, which currently trades at $5 per share. On the other hand, analysts and professionals in this space believe the company should be trading anywhere between $3 on the low end and $12 on the high end. If you're not familiar with this company, Virgin Galactic Inc., ticker symbol SPCE, focuses on the development, manufacturing, and operation of various spaceships and related technology, particularly in the commercial space, where they conduct commercial human space flight while also conducting commercial research and development for various payloads in outer space. Recently, a Jefferies analyst maintained a buy rating for this company. However, he did lower his stock price target from $14 down to $11 due to negative macroeconomic factors. Moving right along here, the next company we're going to talk about is C3.ai, and that company's ticker symbol is AI. The company currently trades at $13 per share, while analysts in the space believe the company should be worth between $13 and $25 over the next 12 months, so clearly it's trading at the lower end of that stock range. C3.ai Inc. operates an enterprise artificial intelligence software company that has international exposure in various parts of the world, such as North America, Europe, the Middle East, Africa, and Asia. What I want to point out about this company is that back in September, they announced that they were going to be extending their partnership with Google Cloud, and this partnership is absolutely amazing, and hopefully it sets them up to further network with Fortune 100 and 200 companies. A Canaccord analyst also maintained a hold rating on this company, but they did lower their stock price target from $16 down to $14 over the next 12 months. Next up, we have UiPath Inc., ticker symbol PATH, which currently has surged almost 15% at the time of this video. Currently, the share price is trading around $14, while experts believe the company should be trading at least around $12 per share and at maximum around or close to $30 per share. If you're not familiar with this company, UiPath Inc. provides an end-to-end automation platform that operates a range of various robotic processes in terms of automation, and they normally do the majority of their business in the United States, Romania, and Japan. A Wells Fargo analyst chimed in on this company back in September, and they lowered their stock price target from $22 down to a $16 stock price prediction. However, that stock prediction is still higher than the share's current price of $14, so this could still be a good company to buy, especially since the company's stock price and share price is surging right now. The next company we have on this list is Unity Software Inc., ticker symbol U, which trades for $41 per share, while experts believe the company should be trading between $16 and $71 on the high end. Unity Software essentially creates real-time 3D content for various video games and mobile apps. And a Morgan Stanley analyst resumed his coverage on this company, and he gave it an equal weight rating with a $27.50 price target, so $27.50. He also says that the risk to reward ratio for this company is very good if the company continues to gain momentum as time goes on. So please, at minimum, keep this company on a watch list. The next company we have on our list is Shopify Inc., ticker symbol SHOP, which trades for $44 per share. Meanwhile, professionals believe the company should be trading at minimum around $28 and at the maximum $81. Shopify is a commerce company that provides a commerce platform and services which they distribute worldwide. A Wells Fargo analyst has a stock price target for this company, and he actually raised his stock price target for this company to a price prediction of $42, which is an increase from the prior price prediction of $38. So that's very bullish and positive to see that analysts and professionals as well as experts are increasing their overall price predictions for this particular company. Up next, we have none other than Datadog, and this is where we enter our first company that has an official buy rating from me. If it has a buy rating next to it, it means I personally have purchased some shares of this company because I believe this company is primed for growth in the future based off of its various financials and its growth rate and the overall business model that the company operates under. Datadog Inc., ticker symbol DDOG, provides a monitoring and analytics platform for developers, information technology operations teams, as well as business users, particularly if they use the cloud in North America. This company also has some international presence, and I believe the future of this company could be very strong. Analysts also agree with my assessment because clearly I think the company is trading at somewhat of a discount. While the lowest price forecast is $82, the company is trading at $75, which currently means that it could be considered undervalued at least over the next 12 months. On top of that, the company could surge as high as $162 over the next year or so. Other more realistic analysts actually have lowered their price target from $120 down to $110 due to the immense amount of inflation that we have been experiencing lately, along with rising interest rates. But despite the overall macroeconomic environment, this company is still set to surge in the future, which is why I put a buy rating next to this company. I also have a buy rating next to one of my favorite companies that I like buying. It's another up-and-coming company, and that is none other than Mercado Libre Inc., ticker symbol MELI. This company currently trades for $950 to buy one share. If that sounds expensive, don't worry. You can always try to find a brokerage account or a brokerage service that allows you to invest into these companies on a fractional basis. Normally, they call this share slices or fractional share investing. So if you want to invest into this company for as little as $1, there are a plethora of various brokerage accounts that you can use to do just that. And with that being said, professionals believe this company should be worth between $800 and $1,650 over the next 12 months. Clearly, I have a buy rating on this company, and I've analyzed this company in detail in previous videos, but I want to make sure this company is still on your radar because they operate a huge online e-commerce platform in Latin America, and they also dabble in fintech technology. A Citi analyst actually identified the true value of this company, and he has a buy rating for Mercado Libre with a price target of $1,050 per share. I also think this company has further growth ahead of it over the next 5 years, so even if you buy the company right now at a price between $800 and $950, if you're planning to hold this company for the long term, it could be extremely valuable to you. So again, that's why I have a buy rating, because I personally have purchased these shares pretty recently. This is then going to lead us to some other cheap stocks right now that are somewhat value investments that offer a good dividend on top of giving investors pretty decent growth. The first company we're going to analyze is Williams-Sonoma, ticker symbol WSM. This company essentially is an omni-channel furniture retailer which owns various famous brands such as Pottery Barn as well as West Elm. Currently, their share price has dropped by around 44% from their 52-week high, so right now it's making the stock look very attractive to value investors, considering that it's only trading at around 7 times their earnings. So their price-to-earnings ratio, also known as their PE ratio or PE multiple, is only 7. But why is this good? Well, currently the share price is trading for around $115 per share, while experts believe the company should be worth at minimum $100 and at maximum $205 over the next 12 months. On top of that, it also gives us a pretty strong dividend yield of 2.67%. So not only are you getting this phenomenal company at a discount, you're also getting a pretty good dividend from it. So you're getting value, growth, and dividend from this company, at least during the short term. The reason we know this is a phenomenal growth company is that even though the valuation is somewhat cheap, you can also look into their financials, where the company has grown their overall earnings per share at an average rate of 50% year over year for the last 3 years. That's an amazing CAGR. Like I've said in past videos, if you can identify companies that are growing their revenues or earnings per share on a continual basis, or at least on an average basis for 3 to 5 years at over a 30% CAGR, that company is absolutely primed for growth. And this company meets that criteria in terms of their earnings per share. On top of that, their revenues could significantly increase over time. According into current forecasts on top of a very strong dividend. So overall, I would say this is a pretty strong company. Next up, we have Fortune Brands Home and Security, ticker symbol FBHS. And this is another company that's creating value for shareholders, and it's another company that's trading relatively cheaply because it's down from its 52-week high by a substantial margin. The reason why the share prices of these companies have fallen as of late is because of inflation as well as concerns about the housing markets. And this is another great stock that's pretty much in value territory. However, it is more expensive than Williams-Sonoma on an earnings basis because this company is trading at around 11 times earnings. The current share price is $63.76, while analysts believe the company should be trading between the range of $57 and $90. This is another company that is trading at a substantial discount as of late. The share price has fallen pretty substantially due to macroeconomic factors, but it gives us good value, decent growth, and a decent dividend. Fortune Brands owns and operates over 24 home and security brands across 3 different segments. Those segments would be water innovations, outdoor and security, as well as cabinets. Fortune Brands is also a company with a strong track record of not only building wealth for their shareholders, but also they have a list of high quality brands and a commitment to return value to shareholders. That's why they have had an incredible 24% CAGR from 2012 all the way to 2021, which is insane. So that's why this company is absolutely primed for growth. So if you want a company that's pretty stable, has fantastic growth, is trading at a discount, and gives you a decent dividend, then go and check out Fortune Brands. Lastly, we have another phenomenal company that I personally own. Remember, we have that buy stamp, and that's my approval on this company that I personally have bought right now, and that is none other than Taiwan Semiconductor. The company recently has sold off by around 44% from its 52-week high, and the ticker symbol for this company is TSM. This is a cyclical semiconductor company, so we can anticipate their overall share price to be quite volatile. However, despite this sell-off, I think this is one of the best companies to buy right now, considering that it's one of the world's largest contract chip manufacturers and is trading at just 14 times earnings, despite the phenomenal growth that we can get and derive from this company. This company supplies and manufactures chips for various other companies like Apple, Nvidia, as well as AMD, known as Advanced Micro Devices. So overall, this is a phenomenal company. The chips that this company makes are actually used in automotive vehicles, mobile devices, high-performing computers, as well as artificial intelligence. Now, you do need to be aware that this company is not a United States company, so we also have to think of political problems that could go on that could influence the overall share price. However, I don't think there's anything wrong putting a small investment into this company like I am doing right now. The current share price is around $81.71, while experts believe the company should be trading between the range of $72 and $130 over the next 12 months, and that's exactly what it's doing. Despite this company's phenomenal growth and it trading at a good discount right now, it also offers their investors a dividend yield of 1.64%, which is phenomenal. This company has paid out their dividend consistently for 17 years in a row. On top of that, this growth stock has grown by around 375% over the last decade, despite the recent sell-off, making this company, as well as some of the other companies on this list, a very compelling buying opportunity. But I would love to hear your thoughts down below on which of these companies you like and which of them are you buying. How did you like my stock picks that I am buying from this list? Remember to go and smash that like button for more videos just like this one. Subscribe if you are new, and I will see you in the next YT video.